Hey traders, welcome back to another very important video. In this video, I want to share with you my exact process that I used for taking my profitable trades that I do in my trading. So first of all, what you have to consider and what you have to keep in mind is that you should not base your analysis on a single type of technical tool. For example, you should not only rely on a wave or a trend analysis. You should neither rely singularly on entry points of candlestick patterns and chart patterns as well. So you have to combine these analyses into your comprehensive analysis that you do, and that's exactly what you are going to see and what you're going to learn in this video. So make sure to watch the video throughout the entire length, and also don't hesitate to reach out or comment down below if you have any questions related to that. So now let's kick things off. But before we do that, please let me tell you about today's sponsor, that is CopyRack. CopyRack is an excellent copy trading and social trading platform which allows you to copy the trades of market leaders. So whenever they are making profit, you are also making a profit. And you can also look at the trading profiles and trading history to see whether they are making profit or not. So if you're interested, please make sure to check the link in the description. Now let's get things started. So first of all, there are three things that you must do in your analysis. The first one is the wave analysis. You have to perform the wave analysis to see what kind of wave is forming, if the market is in ranging market structure like this, or if it's moving in the impulsive and retracement waves like this, so that you can clearly know which direction the market is headed. Because if the market is making these higher highs and higher lows, that would mean market is in bullish trend. And if the market is making these lower highs and lower lows, then that would mean the market is in bearish trend. So you have to first of all perform the wave analysis. And here, as you can see, there are two things that you need to consider, that is the impulsive wave and the retracement wave. The impulsive wave is one in which there is a clear decisive movement of either buyers or sellers. For example, if we go to the charts above, we can see that, let me just clear the screen. So in this case here, let me just turn this off. So in this case here, you can see that this wave is very decisive. So that's why we can call this wave, this movement of market from this area here to here, is very decisive. So this is a impulsive wave in the bullish direction, and you can see the formation of these higher highs and these higher lows within this wave. So that's why this is an impulsive wave. So first of all, you have to pay close attention to the analysis of the wave. And then you have to look for retracement. Retracement would be whenever there is an impulsive move in the market, market always retraces back. For example, if there's this kind of impulsive move, then market will retrace back a little bit to some degree, and then again it will move in the upward direction. So first thing you have to do is you have to look out for the wave analysis. And in the example that we will be covering, I'll show you exactly how you can do that. The second thing that you need to pay attention to is the price reversal point. And those reversal points could be supply or demand zones, could be support or resistance levels, or there could be any key level like FTR or flag limit zones. So when, for example, here, let's imagine a scenario that market made this impulsive move, okay? And then the second thing we have to wait for is the retracement, so the market is retracing back. Now we want to decide which point is going to be the reversal point, because when the market is retracing back, if we want to take a bullish trade, market must move in the upward direction again. So we have to identify what point is this going to be. Now this can be based on any type of these analysis. For example, it could be a supply or demand zone. For example, in this case, if the market was moving in the bullish impulsive wave, and then when market is tracing back, if we can detect a supply zone, or if we can detect a demand zone in this area, then that would be perfect, because now with this demand zone we have a expectation that market will return till this demand zone, and then after that, after picking those orders, pending buy orders, market will again move in the impulsive direction. So this is very important, that you have to consider the price reversal point, where till which level the market is going to reverse. And this is also very important, because now once, let's again imagine a scenario here, we can see that market is moving in the impulsive move, and then also we have a demand zone or a support zone here. So when a market will come to this zone or this area, we are expecting the market to bounce back in the bullish direction. So now let's say market comes here, we have successfully identified our price reversal point. Now we can trade this, but there's a catch. The catch is if we put our stop loss somewhere around here, market just break this stop loss and then again decide to move in the upward direction. So we don't just want to be our trading analysis to be based on this reversal point. We also want to look for an entry point. Now entry point would tell us where our trade should execute, because once we find the entry point, for example, if we see the formation of a pin bar here, okay, if we see the formation of a bullish pin bar that is suggesting that market is going to reverse in the bullish direction because there is a rejection from the buyers at this level, then we would take this trade and this would act as our valid entry point. So these are the things that you have to keep in mind while you're trading or while you're doing any type of technical analysis. Now let me show you these with example. So here we can see that there's the formation of this impulsive wave as I mentioned in the beginning. So let me just change the color of this. So here we can see the formation of this impulsive wave. Now this impulsive wave, after the impulsive wave, there has to be a retracement, and we can also see the formation of this demand zone that is a rally. Okay, here we can see this rally, then there's this base, then again that there's this rally move. So this area here, this high to this low, would act as our demand zone. So now we have two things. First, we can see the formation of this very impulsive move, okay, and then secondly, we have within this impulsive move we have this demand zone. And here, after the formation of demand zone, if market just kept moving upward, we would not, this analysis would not be valid. But now we can see the market retracing in and making these consecutive lower highs and lower lows, telling us that market is retracing a little bit in the downward direction. Now this would be the first step of our analysis that we mentioned, that is we have to do the wave trend analysis. Okay, now this analysis is done. Now what's the next thing? We have to determine our price reversal point. Now in this case here, when the market is reversing or retreating in the retracement, then this point here, that is our demand zone, would act as our reversal point, because our expectation is that after touching this demand zone, market will take the demand and then move in the bullish direction, which we can see it did for a little while, then again it's here, come back here to pick more demand. Now after this analysis, we have done two things. First, we have analyzed that there is this impulsive wave, then market is retracing back. And secondly, we have seen that there is a reversal point that exists that can lead market to move in the bullish direction in future. Now, where do we place our trade exactly? Okay, so because if we had placed our trade somewhere around here, the market might just move in the bearish direction and then hit this stop loss. Okay, but what we want to do is now we want to look for entry point, and the entry point can easily be determined by using any type of candlestick pattern or chart pattern. So in this case here, we can see that there's the formation of this broadening wedge pattern, because if we look here at this market structure, we can see the market making these bigger and bigger waves. So the third wave that we are expecting is going to be even bigger than this one here. So we can see this broadening wedge pattern forming here. So from here, we are pretty sure that after taking this demand, market will move in the bullish direction. So that's how we decide our entry points and our exit points. So in this case here, since this is a demand zone, we would place our stop loss below this demand zone, few pips below this low of this demand zone, and our entry would have been here, which would, our orders would have already been executed. So now we're waiting for the market to pick this supply and move in the bullish direction. So this is the analysis, the proper analysis that I try to do, and I try to find these patterns whenever I'm doing my analysis. There are a lot of other things as well, which I have explained to you what analysis was possible here, but there are a lot of other things that you need to pay attention to. So make sure to pay close attention whenever you're doing analysis, and make sure to combine these things, these three analysis, the three type of analysis, to increase the winning probability of your trades. I hope you like this video, and I hope you were able to understand the concepts that I was trying to teach you in this video. If you have any questions, please comment down below. I would love to answer them. Also, don't forget to like, share, and subscribe. See you in the next video. Thank you.